Start off by just focusing a little bit on our cover page rather than just being a throwaway page. This is the actual pad that we drilled the last 4 wells. We call them this is the Hovenkamp pad. Mr. and Ms. Hovenkamp own the land, and they're the royalty owners of the wells. As you know, in the United States, the minerals are held by the individuals rather than the government, and Mr. and Ms. Hovenkamp call us every day, as you can imagine, and want to find out how the wells are going. So it's quite a team effort, but that's South Texas. You can see the type of territory we're working on, very sparsely populated, very oil and gas friendly area, and clearly we're very lucky to have this kind of opportunity there. And I appreciate a chance to update you. Got our usual disclaimer that several people in Morgan's helped us to write, so we take it that the network understands what that's all about, but obviously there's very little forward looking here, and all of it's been double checked. Just to remind you, for those of you that don't follow our story intimately over the last several years, we are an early stage E&P company. As Sam said, only 6 wells down. We're working in the Eagle Ford Shale. I'll show you a little bit about that and just remind you of that. But this is one of the most prolific oil fields in the world that has produced as high as 2 million barrels a day from just that blue area, which is about 400 miles by 80 miles. You'll notice how when it's superimposed there on the Texas Gulf Coast, it is the old coastline, and that's how it was formed. Back in geologic time, the rivers came down and dumped the sediment into the ocean. The ocean used to be right there along that path, and that's where the mud falls to the bottom. Over millions of years, it gets buried deeply. The pressure and temperature converted into hydrocarbons, and there's where we are. So that's the nature of the Eagle Ford Shale, but it is a very, very prolific oil and gas region. Our acreage is in the yellow box in what's called Dimmitt County. You'll notice it's down near the Texas and Mexican border. The Rio Grande River runs right there alongside of it. That's the little jagged area. It's about a 4.5-hour drive from Houston, and oil and gas has been being produced from Dimmitt County for 80 or 90 years. So this is an area of very vast, large ranches, like I say, very sparsely populated, and a place not a bad place to do business. We have just shy of 9,800 acres. If you look, every time we make a public presentation, that number has grown, and it will continue to grow. I expect us to cross the 10,000 mark here in the next, if not this month, next. We continue to accrete small amounts of acreage, but in a contiguous way where it's all one big block. And I'll explain later why that's very, very important. And as most of you know, we have about 8 of us that run Freedom Oil and Gas. As the CEO, I can tell you that we have a very, very experienced team. Most everybody in our team is in the 25 to 30-year veteran range, and it's not a place right now for people that are young and growing. It's a place where we really need to have an experience level, and that's what we've done as a strategy on our employment. Okay, continue to march along. Talk to you a little bit about why we think this is a very compelling opportunity that we continue to ask you for your support on. We're positioned in a good spot. The oil and gas that we drill in the Eagle Ford is the very volatile oil and condensate. It actually looks yellow rather than black if you set it in a beaker and take a look at it. This means it's a lighter quality crude that gives you a higher flow rate, but it also commands a higher price. The shale in this area, as I just described geologically, is very, very thick. It's over 400 feet. So what that means is it's all oil field, and I'll tell you a little bit about how we're developing it, but it does mean we have multiple opportunities to develop it over time. The production that we get from an average well on our acreage is 70 to 90% liquids. The wells that we have drilled so far have been in the upper range of that, averaging about 80% liquids in the first 2 wells we drilled, and now as high as 90% in these last 4. And there's a little bit behind that we'll talk about a bit later. But the liquids allows for the revenue stream to be stronger and the economics to be better. And this is really what you want to have. From a geological standpoint, we have 350 wells that have been drilled all around our 6, north, south, east, and west. So this gives us a very, very commanding view of the subsurface and how it's going to perform. Our current results, as Sam mentioned, last November when I was here, we had our first 2 wells down. They were just online. They came in at about 1,250 barrels a day. And then we've just put our second 4 wells on the 28th of June. Right now, those things are doing very, very well, and I'll talk about those in great detail as we go through the presentation. And then on the economic side, obviously, we have built this entire business, as Sam described, grassroots. There's no acquisition premiums. There's nothing in here other than the raw work. The land was leased back when oil was at $32, which meant at that time it was completely uneconomic, but we were able to get it very, very inexpensively because other companies had it and could not drill it at that time, and that's how it works in the U.S. If you don't drill it, you lose it over a certain period of time, so we were able to gather this. The Eagle Ford Shale here is about 6,500 feet below the surface. Although that sounds deep, in oil and gas terms, that's very moderate. And we can drill a less expensive well here because that depth is not very great, and the Eagle Ford drills very easily. It's a very forgiving formation, and it's not difficult, and that gives us the $5 million cost to drill and frack the wells. We have very, very low operating expenses and very, very low transportation expenses. Our wells are simple. They flow on their own with the help of a little gas lift later in their life, require very little maintenance, very little manpower intervention, and our overall expenses in the field are about $6 per barrel, and that's what we'll average over the life of the operations of these wells. And then last but not least, our early projection of the wells and how they're going to perform over their lives. I'll show you a graph that they're very economic across a broad range of outcomes, which should give our investors a great deal of comfort. So as you can see, I think our fundamentals are pretty sound. Continuing on that, we think as you go past that, we've positioned this where it's got a couple of advantages that we would want you to know about. First of all, we operate all of it and we own it all 100%. So we have no dilution or no sharing except for the royalty owners. As I mentioned on that cover page, the people that own the oil and gas below the ground get 25% cost-free of the revenue stream, and then we get the other 75 and bear all the costs. But that's the equation, and we have 100% of the situation. Our existing acreage has been continuously expanded over time, and I think I can tell the group here today that will continue to be. There continues to be small bits that follow on, and obviously we're always looking for something large to add on to this, but in the meantime, we'll continue to grow and accrete the leasehold. And as I said, we try to do it where it's all connected together. This gives us a contiguous acreage position and allows us to drill the wells as long of laterals as we desire and to put the oil and gas development together on a very simple basis. And I'll show you what that looks like in a minute, and I think you'll see that it's as simple as it could be. I've already commented on the geology, but just suffice it to say, not only do we have a lot of wells around us, but we have all the production data. We know how all those wells are performed, how much oil they make, how much gas, how much condensate, and this gives us our ability to predict with you with a great deal of confidence how the things are going to perform. In addition to that, before ever drilling our first horizontal well, we drilled a vertical well and measured every single thing in a vertical sense. I'll show you a map in a minute about what that uncovered, but it allows us to tell you that there's at least 4 horizons that we'll be able to develop, provided they're economic over time, but we know they're full of oil. And that includes the Austin Chalk, that is the other big prominent domain out here in addition to the Eagle Ford. Lastly, we did purchase 5 cores. If you're not familiar with what a core is, we actually drill through the formation with a hollow barrel and pull the core to the surface, and we can actually lay it on a table and look at it. So we have 5 of these that surround our acreage, and to be able to lay those, in, like I say, on the slab and measure the condensate, the oil, all the different constituent parts of it tells us a great deal about what we're going to get. And that's part of our opportunity with you to address that with our investors, that we're very, very confident. Lastly, as most good companies do, we don't tell you something we have not verified. Our reserves are done by Nidland & Sewell, and most of our technical data is either Schlumberger or a company called W.D. Von Gonten & Associates, which is a reservoir group in town in Houston to validate most everything that I've seen and show you today. So a lot of backup on what I'm going to tell you. Continuing on, let's just jump to an update from where we were last time. The green area on this map outlines our acreage position, and as you can see, that's about 9,800 acres, as I mentioned to you. Shouting out the wells that are imposed here, the green area is what I was able to show you last November. Freedom had done what we call phase 1, our first 2 wells. They averaged about 1,250 barrels of oil equivalent a day. That means the oil and gas are converted into barrels, and 80% of that was liquids. Now I'm able to show, you can see the ellipse of where it's located on our acreage in the southeast corner. Our next 4 wells, we moved 1 mile to the west, right along strike, as we call it, with where we drilled the first 2 wells. And now you can see where we've just put those 4 wells online on the 28th of June. And as of the 25th of July, they had averaged 1,187 barrels a day of oil equivalent. The keynote there is it's 90% liquids at that point, and that's, like I say, that's even more economic than the first wells, which were very economic. Rather than just to continue to talk about ourselves, look at the expanded area here. You can see that literally we're surrounded by other operators that have done very, very well. Some of them, like Chesapeake, to as high as 20 wells that have averaged almost 1,000 barrels a day. So Sanchez to our south, Murphy and Chesapeake to the east, and Protege right across the fence line with some excellent results. So our geology is sound. It's really a matter of execution and doing it right. And as you can see, we think we're in a very good neighborhood. These are all wells that have been drilled since 2017, so they're brand new. There's a little bit of a story behind that I'll briefly comment on around how we're fracking these things a little bit differently than we were prior to that, and that's resulting in the additional gains that you can see here. That's very, very good. All right, so let's talk about our 4 wells now that we've just put online. As I mentioned, this is done from the Hoven Camp pad, put online on the 28th. In regards to the 4 wells, first of all, as regards to drilling them, on 3 of our 4 wells that we've just drilled, we averaged 12 days, but from the time we started to the time we stopped. That's compared to a 16-day average of the first 2 wells. The only reason all 4 wells did not perform like that was we had a small rig problem on 1 well that caused us to have to halt for a day or so. But other than that, our drilling performance has been improved, and that's a really important aspect of getting the well costs down over time. Very pleased with that. We fracked these wells at twice the intensity. What that means is the number of fractures initiated into the reservoir was 2 times as large as we did on the first 2 wells, on the 2 Wilson wells. I've got a brief cartoon here in a second to show you what that looks like, but that allows more oil and gas, we think, to be developed over the life of the well. The third big change is our sand and water concentrations were very different on these than the first. The entire industry is evolving to where we use a different type of sand and we use more water, and we think this will allow for a more effective fracture network over the life of the wells. And then lastly, once the wells are producing and online, we're holding back pressure on them. This has causes their rate to be restricted, but it allows to keep the pressure in the reservoir longer, and hopefully this will allow for a better flow rate over the life of the well. There's a lot of physics behind that to support that, and we have measured that in a number of the wells around us and know it to be true. So these are the 3 things that we've changed. The wells, like I say, 1,187 barrels of oil equivalent a day. 90% of that either oil or the liquids that come from the gas, and then only 10% of our revenue stream is gas oriented, and as you know, that's a lower price. The 2 graphs at the bottom are very important. The one on the bottom left shows the red line is how the pressure is being managed on these new wells, and as you can see, we're declining that pressure at the surface at a much slower rate as compared to the green line below it, where we let the pressure out very, very rapidly. And then on the right-hand side is the production of the old wells versus the new. And as you can see, we started out the first 2 wells by letting them go very, very hard. And although they had high rates, they came off a little later. And now, as you can see, we're measuring these new wells where we hold them back a little bit, keep the pressure there, keep the liquids rate high, and then they cross over and pass the first wells here recently. So that's what's going on there, and we think we're off to a very good start. And I will tell you, ladies and gentlemen, none of this means we figured it out exactly. As you can see, these are things that we're moving around and working with industry, and over time we'll develop the optimum case. But we do like the position that we've moved from and now where we are. Here's the cartoon I was going to tell you about the fracturing. And if you study this, and I know being in Australia, there's not a lot of this going on around, but as you can see, going back to very basics, you drill the well down vertically and then you turn it horizontally. I think most of you understand that. And we do that with a selected interval that we've picked through detailed geology and reservoir engineering as to exactly what we call that landing point. That's the point where you turn it horizontally there. But the important data is there in that little box above the cartoon. That's in the Wilson B area. The wells had a 6,800-foot lateral length. That's what the LL stands for. So the lateral part of the well that's horizontal is 6,800 feet long. We fracked each well 27 times. That's called a stage. But then within the stage, the perforations in the pipe are what's called clusters. And in the Wilson wells, we had 6 clusters per stage times 27 stages, or a total of 162 clusters in the well. That means 162 different fractures went out into the reservoir. Look at what we did on the Hovenkamp wells. They're drilled longer. First of all, they're 7,400 feet lateral length, a little longer. We got a little better, we got a little more confidence. So we're drilling the wells a little bit longer. That means we fracked it 32 times because it had a longer lateral interval. But in each one of those stages, we have 12 clusters rather than 6. And now a total of 384 fractures initiated. So double the amount of reservoir that's been broken up below the surface. And as you know, the oil and gas is released into those fractures, and that's how it produces. So we're very confident, and we've measured this in other wells around us, that these wells have a better chance of producing at a higher rate for longer and ultimately giving us more oil and gas over their life. In a cartoon view, as you can see down below, you can see the intensity of the fracture initiations in the Hovenkamp wells as opposed to the Wilson wells, and I think that ought to be obvious to you. This is a very, very big change, okay? I'll briefly comment about, while I've got you, about the sand. The sand that we stick in, as you know, we stick sand into the fractures to hold them open. What's happened in the industry is we've moved from it being big sand, which we thought was the best thing, to much smaller sand. And if I've visited with a number of you individually, but I want you to know the sand that we're now using for at least half in its early part of the fracture looks more like flour or talcum powder or baby powder. It is down at that level of size. And what that means is the individual molecules of sand are so small that when they go in the fractures, they can go all the way to the tip of the fracture, no matter how small the cavity is. This allows us to maybe have fractures that are open for 600 and 800 feet. Rather than 200 and 300 feet, because the smaller sand can get back there and hold the fracture open. So those are the big changes. More fractures, smaller sand, in there in a more intense way, giving us a longer path and more life over the well, over its productive life. Okay, drilling performance and a brand new rig on the way. Talk about that for just a second. First of all, in our drilling performance, we've now drilled 6 wells, and every single well has come down in cost. That's our team getting better. That's us getting our sea legs under us and on operating at more at a level where we know it to be competitive. Put that in a different way, our phase 2 wells, the 4 wells we've just drilled, as you saw, they are 600 feet longer, but they were actually lower cost than the first 2. So that means that our capital efficiency is getting better, and over time, that's a very important part of the economic equation here. Our wells now are, these last 4 have averaged about 1.35 million to drill and put the pipe in and do everything prior to fracturing. And that's very, very competitive in the area. And to be able to do that after only 6 wells, we're extremely proud of. The second part of the cost of drilling and completing these wells is the completion. And that second piece is at about $4 million. The Hovenkamp wells we fractured, we as I said, with very intensely, we then clean them out, get all the plugs. There's a number of different mechanical aspects of that. Get that cleaned out, and then we flow it back through portable separation to get all the water recovered. And with twice the fractures, these wells only cost us $400,000 more to frack than the first 2. So do know that when you add those 2 numbers together, that's the total cost to drill and complete a well, about $5.35 million. And that continues to decline. Secondly, now as a result of that performance and feeling like we've got a very economic opportunity here, we've now leased a new rig. It is a rig from Orion Drilling Company, which is a South Texas-based operator. It has been drilling now for 4 years for an offset competitor since it was built and put into service. We will get this rig. It has a great operating record. It has a crew that has been on the rig now for 4 years. All the mature things that you like to get so that on day one you know you'll be strong and effective. We think this rig has. Plus it has the proper horsepower and the torque and ability to do the work that we want that'll be optimized for our drilling depth. We took the option for a 6-month firm contract and then a second option after that first 6 months to release it. And then obviously we could go even further with that, but that's what we've got commercially for right now. So very pleased with that. It shows up on the 20th. We got a message on Friday. Our very best guess is the 20th of August, and then we'll assemble it on our location and begin to work. Okay. All right, so obviously this gives us, as Sam says, the ability to not just do little 1 or 2 wells, but now drill continuously for the next year. And that's a big game changer. We also feel that when you start doing this every single day, we'll bring the cost down even more, and 10% more is our target in that sense. All right? Let's go back now and move back. Now that as we drill these wells, and as you can see, we think we're being fairly effective, what are we drilling through? And this is our multiple formations that I've described. Remember, I told you that we drilled a vertical well and did not turn it horizontal and measured all this that you can see. And what we found there is that first we passed through this very large Austin Chalk area. Right now we have no Austin Chalk development going on, but we have companies immediately adjacent to us that all they drill is Austin Chalk wells. So it's a nice thing to have in our portfolio going forward. It's very large, it's oil filled, we've measured it, and certainly a future opportunity. Once you pass through the Austin Chalk in depth, the next horizon you go through is called the Upper Eagle Ford. And all that is a transition over geologic time from the shale in the Lower Eagle Ford into the Austin Chalk, which is a true chalk or limestone-based contiguous strata. So the Upper Eagle Ford is very large, and it's full of oil also. All this is being generated from the Lower Eagle Ford. And then lastly, you get to our Lower Eagle Ford, which is our main target. And our first 6 wells have all been drilled across that bottom row there, that darker blue symbol. So I'll show you in a map in a minute where they're located. But all we've started to develop is the very lowest part, what we think are multiple opportunities going forward. So the number of wells that we can possibly drill is not a problem for Freedom. And we've got a lot of running room, as you can see, going forward. Okay, so now let's take a look from the sky. This is looking down from above, and those red lines and blue lines and green lines are what are meant to depict the laterals that are 6,500 feet below the ground, and what the wellbore looks like from looking at it from above. There are about 4 important components that I would want you to get from this page. The first one is, let's look at the green little lines. They're to the south or to the bottom of the page, and those depict the 6 wells that we've already drilled. You'll notice the 2 green ones over there in the bottom right-hand side. Those are the Wilson wells. They're connected at the top, as you can see. They start from the very same point. And then if you move to the left, or which would be the west on this, as you can see, you've got 4 other green lines, and those are the Hovenkamp wells that we've just drilled. So as you can see, those are about a mile apart. They've all performed exactly the same. They're all very strong. They're all the things that I mentioned. 1,250 barrels a day initially from the Wilson wells, 1,187 from the Hovenkamp wells. So that's point number 1, is I wanted to show you where we've drilled and show you why we have a lot of confidence that now our area of focus for the next year or so will be the blue lines. If you'll notice, the blue lines are in between the green, but more importantly also they start to go north from there. What that means is, on that very cover page, that Hovenkamp block of land that I showed you, we'll drill wells off of that exact same pad, some of which have gone south and some of which go north. So we don't have to build the pad again. We don't have to build the roads again. All the production equipment is already sitting there, and we'll be able to utilize that and save money going forward. So the development here is to bring the wells north and south in that same central area, and that's where we'll be focused on the next year as the rig contract comes on. Once again, we would want you to say, Mike, how do you think the wells are going to perform? Look how close they are to each other and look how they're doing. So that's where we get a great deal of that confidence. The third point to take from that map is the red. And as you'll see, the red areas are where we'll be doing for the next 2 to 3 years as we develop the field in a very simple and organized way. If we did not have all the acreage here, we would not be able to do this. And that's why we've been painstakingly trying to make sure that our land is always contiguous. Okay, so those are our drilling plans that we've already performed, what we'll be focusing on in the next year, and then what we'll be focused on for the next several years. How have the wells performed? Our first 2 wells have now been productive long enough for me to show you a little bit about how we think they're doing. The green line was what our forecast was, and if you'll notice the little yellow dot, which is where the average production of the first 2 wells sits today, is tracking pretty close to that, even slightly above it. So as you can see, we have a range of outcomes there. It's still very early, but it's tracking exactly as we had hoped for. if things were a little better than that or a little worse than that over time, all this is still highly economic. So we're very pleased with the way this is performing, and we'll keep you posted on that. But that's how we hope the next 4 wells will perform also, because these first 2 are doing well. The next page converts that same story into revenue and allows you to see how the revenue, based on a simple set of pro forma economics, basically the forward curve. I've listed that at the bottom of this page. As you can see, there's a line for WTI that goes out from 2018 to 2023. That's the New York Mercantile Exchange that most of you are familiar with, and that's if you wanted to hedge your oil and sell it forward, that's how you would sell it at this time, or at least it was on August the 1st. That changes slightly every day. You'll notice that there's a gas figure in there. Gas is not worth a whole lot, and that's why we don't pay a lot of attention to it in our economics or talk about it a great deal. And thirdly is the NGLs, and that's the liquids that are extracted from the gas when it's taken through a processing plant. That right now, those NGLs average about 36% of the WTI value. So if the wells are drilled and over time, which we're doing, and then have the outcome based on the reserves that I've just shown you, then this is the revenue stream that we're expecting to get. And once again, we have a broad range there to look at, and very pleased with how we think that will work. All right. The last thing I would mention is just pricing in general. You can, in addition to oil and gas prices and what your thoughts might be on the fact that OPEC has very limited supply ability to do anything today. The Russians have a little bit, but oil supply versus demand is very, very tight. Also, over the last 5 years, because of oil prices being low, very little investment's been made. We think both of those are favorable aspects for longer term or intermediate term oil prices. But on this page, we also have the advantage of where our wells are located. Being located on the Gulf Coast allows us to be and having a very light oil, which is about 44 to 46 degree API, we have the ability to be the equivalent of an import. So if you produce an Eagle Ford barrel and you send it to the refinery, that's one less barrel that the refinery has to import from overseas. So therefore, we get a bit of that overseas premium. It's called LLS, Louisiana Light Sweet. You can go on and look at it. It's sold, and it's a benchmark crude. But that's been averaging $4 to $6 above WTI. And that's the pricing that we receive for our oil. So not only are we in a favorable oil environment, macro-wise, but we get a higher price in addition to that. Lastly, we have a lot of pipeline availability in our area, so we ship for very, very low cost directly to the refineries. So a very favorable situation for Freedom there. Next is probably the most strategic page in our package, and that is our lending facility. As all of you are aware, in the United States, we have this ability to take some of our production, sell it forward to a bank, and get money to do the development. It's called reserve-based lending. It's got a whole formula to itself, but suffice it to say, it's a very, very lucrative arrangement for a company like ours. The interest rate on it is 5% or less, and we're now working with Wells Fargo, able to show them our first 6 wells, which was the minimum they thought we needed, and how they're performing. And I fully expect us to wrap up the reserve-based lending facility with them over the next 2 to 3 to 4 weeks. We've shown them our ability to produce these wells, and I think we're about to round the corner. So we'll announce this as soon as it's done, but it's looking very, very promising, and very promising in the near term. You can see some of the terms over there, what's all involved with doing so, but most of that is very industry standard, nothing unique to Freedom there. It's just a very, very lucrative way to leverage our business. And as Sam said, with this vehicle in place and with our rig, we're in excellent shape to be able to start moving the business forward in a big way. How far can we move it forward? This chart describes that. We hope to drill 2 wells a month with our new rig over the next 6 months. That would be 12 wells in that length of time. We have the option then to extend beyond that, as I've said, up to a year, if not further. But let's just take a look at both of those scenarios. Over a 6-month period at $5 million a well, you're talking about $60 million of capital, or about $81 million Australian in that same figure. The graphs at the bottom show that if we execute as per the guidance, 2 wells a month, at the performance that we're expecting, and at the operating expenses and all that we're already experiencing, we should have production growth from about 3,000 barrels a day equivalent to over 6,000 barrels a day. We also should have EBITDA that will start to average over $50 million annually, and and then the ability for the RBL and this EBITDA to then be the fuel that we use to run the continuous program. At the bottom left, you can see the production growth that we expect to experience. The orange bars are if we drill for 6 months and then stop, and the blue bars say we take the second 6-month option and continue to go, which is obviously what we intend to do. And as you can see how that grows in both the volumes grow with the number of wells. Lastly, on the right-hand side, you have the EBITDA in the same basic story. Orange is 6 months, and the blue continues for the year. And as you can see, we get up near $10 million of projected EBITDA annually on that. All right, so wrapping it up, 6 wells, over 7,000 feet. Early performance, very, very solid. All the necessary support is in place. The infrastructure, the pipelines, all the agreements are in place. We've averaged about 1,187 barrels on these last 4. Gives us over 5,000 barrels a day of production at the present time. Our well costs have declined. They're certainly on target. We expect that to improve and our technology to improve, as you've seen from our fracking. And then lastly, this very strategic and last bit of our full story being our lending facility being in place here near term and then really starting to move the company forward. So I know Morgan's has been a long-term supporter of us. We're very, very grateful, but I hope you can see now that the story is beginning to become complete. And we look forward to working with you how we have our investor base out there expand and become a larger part of support for this business going forward and get the share price up. Okay. So I included a few things about our capital structure and what's going on, but basically that's our story as you can see. So Sam, I'll turn it back to you or to the network for any questions anyone might have.